All right, welcome everyone to the Qualtrim scenarios tutorial. That's what this is going to be. This is the first tutorial, and I'm excited to show you this tool that we've been working on for a long time. So what I plan on doing in this video is showing you an overview of what the tool is for, what it does, how to use it, and then I'm going to be doing a scenario or a couple of them on different companies like Texas Roadhouse. We're going to run through some scenarios of what I think will probably happen there, and it will show you how the tool will put my thoughts onto paper. It'll show you visually what I'm thinking. So that is the tool scenarios. Let's go ahead and just go to Qualtrim. If you log into Qualtrim now, this has been pushed, so everybody has this. And if you open up the menu, you'll see a new page called Scenarios. That's what we're talking about today. If you don't see this page, hit the refresh button a few times. Just refresh the page like 5 times and it should pop up. If you still don't see it, then you probably need to clear cache or clear cookies. But everybody has it. There's no, if you have a Qualtrim.com membership, then you have scenarios. Let's go into it. First of all, the first thing I want to point out is we have this warning here. This feature is currently in beta. We're making regular updates and fixes. Please let us know if you experience any issues. The reason that I have it currently in beta is because this is brand new and there is going to be bugs for at least the first month. We do a refining period where we take in all the bugs, we fix them, we take in more bugs, we fix them, and then over the course of a month or two, it goes from having a lot of bugs to having no bugs. That's the route this is going to take. So initially, first, there's going to be lots of little things wrong with them. If you find something wrong, there's a new channel called Scenarios on the Discord right under the general chat. Just leave a comment there. I'll put it down on paper and then I'll send it to my developer and we'll get it fixed. So this is in beta. Don't expect it to be perfect, but we're going to run through a couple different scenarios here. It says, welcome to Qualtrim Scenarios. Please enter a stock ticker symbol to start creating scenarios. Let's go ahead and let's start off with Texas Roadhouse. This is a company I love doing analysis on because it's straightforward. It's an easy company. When I type in TXRH, you can see what it does here. Let me see if I can zoom in. Well, that looks good this way. It creates this new panel here. I can go full screen for a minute. And you see right here, it brings in the logo. So we know what we're talking about. We know we're on the same page, the company that we entered in. We have the name here. And this is a multi-selector. And you can also search in this selector as well. Because over time, you're not going to have just one company. You're probably going to be doing scenarios on potentially dozens of companies. So to sift through that list and to search through it, you actually have a search select box here. You can delete the scenario there, as well as it pulls up some basic information to help guide your analysis on this stock. Year-over-year change with these metrics. So we have the 2022 metrics. What happened year over year, right? How did these things change? I can see that their revenue grew by almost 16%. Their EBITDA went up about 9%. CapEx went up 22%. So there's an increase, a big increase in the price of constructing new restaurants for Texas Roadhouse, or they built more of them. But either way, their CapEx went up. Their tax expense went up slightly, and their cash flows it was basically flat, went down less than 1%. So their free cash flow, that's what that's recording. So right there, we have some basic information. But of course, anytime I'm doing a scenario, I like to open up a new tab of Qualtrim. So I click on this, open up a new tab, and I like to open up the same company as well so that I can kind of go back and forth, and I'll show you what I mean here later. So we have 2 tabs open. I can flip back and forth between the one I'm doing this scenario on and in Qualtrim Insights so I can reference some of the info here. Let's go ahead and go back to this. Now, this brings up the stock, but this is not a scenario. You'll see a button here called Create Scenario. And this bar right here, this gray bar, is where all the scenarios are for this stock. So at the top level, you have the company. Then you have your little scenarios you've created. So you can create a base case, a bull case, a bear case. Or you can create a super aggressive bull case if you have a very divergent view from the analyst consensus, right? You can create a bunch of different scenarios and they'll list out right here with the name of them. So what I'm going to do is I'm going to click Create Scenario. We have this new thing pop up right here. You see this just appeared, and you can collapse this or expand this, but it gives you further instructions here. So let's go ahead and read these instructions. When I research and I look at all the main drivers of valuation, repeatedly, I've seen that there's 4 main drivers of valuation. One of them is the annual compounded revenue growth. So revenue top line growth is a huge driver of the valuation of a company. Another big driver is the margins of the company. We measure the margins by the percentage of EBITDA to revenue. There's different ways to measure margins, but this is one that's it's a very smooth, easy way to do it. So we have the margins of the company. The third valuation driver of a company is the capital efficiency of the company. And the way that I measure capital efficiency, and I think a very good way of measuring it, is the percentage of CapEx to revenue. So out of all the revenue they gather, how much of that revenue goes to CapEx, right? If a company spends a ton of money on CapEx, it's not that efficient. If it spends very small amounts on CapEx, it's a pretty efficient company. And so we have the revenue growth, we have the margins, that's the EBITDA to revenue. We have the percentage of CapEx to revenue, which is the capital efficiency. And then we have this final toggle here, which is the predictability of the company. And this part is important in terms of valuation because predictability is another way of saying, how risky the company is. If a company is more predictable, that means it's less risky. If a company is less predictable, that means it's more risky. The reason that this one is subjective and you can't use any numbers to measure it is because you're trying to do qualitative, you're trying to look at the business and the moat of the business, the durability of the business. So you can't really quantify the predictability in just numbers, but you can have numbers help inform your rating here. Qualtrim gives you 3 different options for predictability: low, medium, and high. So I'll go over all of these in depth, but these are the 4 main drivers of valuation and of the future growth of a company. Everything that you do with a company, everything you're looking at qualitatively, quantitatively, the research on the moat, the market, the total addressable market, all of that boils down to one of these 4 factors. And if something boils down, if you're looking up something in a company, try to find anything that does not boil down to one of these 4 factors. Literally everything does. Every bit of research you do will find itself in one of these factors. It'll end up in the revenue growth. It'll end up in the margins. It'll end up in the capital efficiency, and it will impact the predictability of the company. Every single piece of research we ever do will end up in these 4 factors. These 4 factors alone can determine the real intrinsic value of a company. Now, it says here in Qualtrim, the 4 biggest factors, and I put this in writing because I want people to see it as they're going through this. The 4 biggest drivers of intrinsic value are revenue growth, margins, capital efficiency, and predictability. The more accurate you can estimate these metrics, the more accurate your return prediction will be on Qualtrim scenarios. So that's pretty straightforward. The return projection you get is only going to be really as accurate as your inputs. If you put in bad data and you really, you're way off on your revenue growth expectations, way off on your margin and capital efficiency, if you rate a company that's really not predictable as being highly predictable, you're not going to get a good return estimate. To get an accurate return estimate, you have to try to put in as accurate of projections as you can. And like it says here, the more accurate you can make your assumptions and the better informed you can make your assumptions, the more accurate Qualtrim will be with the outcome. But let's go ahead and just look at these numbers. We'll just review them. Last year, Texas Roadhouse had 16% growth. Now, if I look at the graph here, one update we did, by the way, took away the other CAGRs. We're bringing those back. So those are going to be back. But it will normally have the 1 year, 2 year, 5 year, and 10 year here. But what I've observed with Texas Roadhouse is, yes, they had incredibly fast growth last year, about 16%. This it's a growth company. Texas Roadhouse grows fast, but it's probably not going to grow quite that fast for the next 5 years. So I'm not going to put in 2 scenarios that it will grow at 16% because I don't expect that. Now, if I want to create this as a bull case, I could do that. But what I'm going to do here is skip to this box. I'm going to say base case. And you can name these whatever you want, right? I'm just naming them boring. This is going to be the base case, which means like what I most likely think is going to happen. In my base case, I don't really believe Texas Roadhouse will grow 16% per year for the next 5 years. I think it's more likely to slow down to their historical average, which is around 12 to 13%. I think they're going to grow fast because they still actively are opening up new restaurants, about 25 per year. As well as, I'm really bullish on the restaurant sector. I think the same secular trends that are driving growth of dual working households, less children at home, people have more money now than they've ever had before in history. Millennials are the richest generation for any generation this age. There's a lot of factors that drive restaurant growth, discretionary spending. So I don't think it's going to go down to like 5 to 7%, but I don't think it's going to stick at 16%. Let's say that I think it's going to be, for right now, I'll say 13% for the next 5 years. Seems a little aggressive, but I don't think that's out of the realm of possibility. I think that's really achievable by Texas Roadhouse. Now, in terms of the EBITDA margin, I'm going to leave this about the same. I might lower a little bit, or not lower this. I might keep this up a little bit because I think the margins might go up a little bit over time. So I'm not going to adjust this too aggressively. Margins are very sensitive on restaurants. Even a couple percentages of margins make a huge difference. So I'm going to adjust this up to 12% flat. That means that Texas Roadhouse will find ways to raise their margins slightly, just slightly over the next 5 years. Okay, so not a huge aggressive change there, but let's say that they introduce more pricing power on their margaritas and, whatever. They find ways to increase their margins a little bit. Let's say the price of cattle goes down a little bit. Cattle's really expensive last year. So that's one thing that is going to affect them. We have the capital efficiency of the company. Now, this is a little bit confusing because this is the inverse, meaning the percentage of CapEx to revenue. The way that you find these numbers, by the way, I'll go back and go to this one, the EBITDA to revenue. The way that you can find this percentage, the 12%, is you simply take the revenue. So I can take 2022 and go $4 billion of revenue, and I can go down to the EBITDA. The EBITDA is right here. 2022 EBITDA is $460 million. 460 million into 4 billion is roughly 12%. So that's the percentage at EBITDA to revenue. You can find all this info right on Qualtrim Insights. So you're just dividing one number by the other. And the same thing for the CapEx, for the capital efficiency, the percentage of CapEx to revenue. So in this case, we'd look at the revenue, $4 billion in 2022, and then we look at the CapEx, which was, let's see, the CapEx is right here. We can filter that out. In 2022, the CapEx was $246 million, which is about 6%. So you can start making judgment calls here. We can go back to the CapEx and we can see, is the CapEx going to grow right in line with the revenue? Is it going to stay a flat 6% over the next 5 years? Will the CapEx grow faster than revenue or grow slower than revenue? If the revenue grows faster than the CapEx, that means that this percentage should go down. And as this percentage goes down, capital efficiency goes up. So capital efficient companies have a lower percentage here. The closer this is to zero, the more capital efficient the company. So like S&P Global is super capital efficient. They have almost no CapEx. Railroads aren't as capital efficient. Theirs are like 15%. In the case of Texas Roadhouse, we have 6% here. I'm going to make a judgment call here that the CapEx spend will grow actually slower than revenue over the next 5 years because they're opening up a relatively smaller amount of new restaurants, which is their biggest CapEx spend, compared to their overall revenue growth. Because most of their revenue growth is being driven by same store sales, the same locations selling more, rather than opening up new locations. So I'm going to say this will probably go down to like, let's just do some assumptions here, 5.5% from 6%. So it's going to tick down slightly. And then we have so let me just review before we move on. We have the revenue growth. I'm basing that off of a moderate slowdown over the next 5 years because I think 16% is pretty aggressive. But to model that out properly, I'd have to look at how many new stores are going to open and then what I think the same store sales will be. That way I could get a more accurate revenue growth. The margins, the percentage of EBITDA revenue, this should go up over time slightly as the company becomes more efficient. They push margins up a little bit, but some of this is out of restaurants' control. It does depend on things like cattle prices for Texas Roadhouse. The capital efficiency is something more in their control, because if they open up fewer restaurants or the same amount of restaurants while their revenue's growing, the actual percentage of capex to revenue gets smaller and smaller and smaller. So I'm ticking this down from a current 6.3 to around a 5.5 over 5 years. And again, these are all 5-year projections. The reason I went with 5 years is I think that going out 10 years is just way too difficult. Nobody knows where a company's going to be in 10 years, but 5 years is out close enough that we can try to make some real fair assessments. So all of this is a 5-year estimate. We get to the final one here, which is the predictability of a company. The way to think about the predictability, if a company is highly predictable, the market will pay a higher multiple on the earnings, and the market will price it at a lower free cash flow yield. So companies that are highly predictable have lower free cash flow yields. Costco has a low free cash flow yield, meaning a high multiple on the free cash flow, because the company is highly predictable. Who doesn't think Costco is going to be around in 10 years? With that level of predictability in the stock, investors price it higher. Smaller free cash flow yield, higher earnings multiple, more predictable. If a company is unpredictable, if it's just all over the place and you don't know what's going to happen, if it's a company that, some small pharmaceutical biotech company, it might be good this year, but it might not be good next year. You can't really see what's going to happen with a company in a small biotech pharma company in 10 years or in 5 years. So that company has a low predictability. Low predictability means that the company typically has a higher free cash flow yield. So it'll trade at crazy high free cash flow yields of 5, 6, 7, even up to 10 or above. That's because investors know that it might be producing cash flow today, but tomorrow it might not, right? In the future, they're not so sure about it. So this comes up to the judgment that you have for a company. But the more accurate you can place this rating, the more accurate Qualtrim will be at assessing the future returns. So don't kid yourself. If you're looking at a company that's unpredictable by nature, that trades at a lower valuation because it's inherently unpredictable, then put it as low predictability. Don't put it as high predictability because it's going to give you an inaccurate assessment. It's going to price the company as if it's a Costco when you're really pricing a pharmaceutical biotech company, right? So we want to make these as accurate as possible. Now, if every company that I'm looking at, for the most part, I consider to be medium or high predictability. In the case of Texas Roadhouse, I have to be honest here. If I was assessing Costco, I would put that as high predictability. If I was assessing, like these really stable moat companies like Microsoft, I'd put it as high predictability. Even though I think Texas Roadhouse is very predictable, it's still a restaurant. It still has input prices from cattle and wage inflation with all of their servers. They still face intense competition. They're not a monopoly. So I can't put this one in the same tier as I can Costco. I'm going to put this one as medium predictability. I don't think it's low, because low are companies like a small oil company that might strike gold or it might not. That's a low predictability company. For me, Texas Roadhouse is a medium. So we have the assumptions right there. That's the 4 main assumptions that drive the valuation: revenue growth, margins, capital efficiency, and predictability. We name the case. I named it base case. We put in the starting year, and then we can put in the current market cap. Now, this lets you go back in time a little bit if you want. You can fill out a market cap here, or you can click this button right there, and Qualtrim will automatically bring in the market cap today. So there we have it right there. We'll hit create. And this is where things get really, really cool. So I press the button and we notice something else pop up below, right? We have the 5-year projected financials. So if you were to do a discounted cash flow for a company over the next 5 years, you would map out the 5-year financials of the company. Well, Qualtrim took this information, your inputs, and then it created a cash flow projection. So you can see it right there. We have the revenue, which we believe is going to grow at 13% per year. So we have the 13% revenue growth starting from 4.01 billion in 2022 to 4.54, 5.13, all the way up to 7.4 billion in 2027. So that's the length of our cash flow projections here. Now, a cool thing that Qualtrim allows you to do is, let's say that this is too simplistic and you don't want to give just a flat revenue growth, but you think it's going to taper off these last 3 years. Well, you could go in and you could hit you could just click on this and edit the numbers. So you can change these numbers anytime you want, but these numbers are what your simple assumptions here are based off of. So I'm going to just keep what I have right now. I think it's going to have, on average, 13% compounded growth over the next 5 years. In 2027, my 5-year analysis shows that at the year 2027, I'll have $7.4 billion in free cash flow. Then we have the EBITDA. The EBITDA is also going to grow in line. So we have $460 million in EBITDA. And with an EBITDA margin, remember we have EBITDA margin of 12%. That is the margin at the end 2027. Well, remember the EBITDA margin, the margins of the company started a little bit lower. They started at 11.46%. I said they're going to move up to 12%. So notice how Qualtrim does this. It gradually increases from the starting point, 11.46, to the finishing point, 12%. So we have 11.46% margins, 11.57, 11.68, 11.78, 11.89, and 12. It perfectly divides it so it's a nice gradual change over time with those margins. And this is the way that you would do it on a normal discounted cash flow analysis. You would put where you think the margins are going to go, where they're going to start, and then you would have a gradual increase in margins over time. So again, you can look at this and you can edit what you think the starting EBITDA will be. You can edit the revenue, but these are based off of the assumptions up here to make it very simple. Then we have the CapEx. Remember that the capital efficiency of the company is the percentage of CapEx to revenue. So at the percentage CapEx here and the starting CapEx, we have the same thing. It starts at 6.13. That's what it was in 2022. So that's the CapEx percent. And again, I thought that they're going to improve their CapEx spending percentage a little bit. The capital efficiency is going to go up. The CapEx spend is going to go down. So it's going to go from a 6.13% down to a 5.5. And Qualtrim does it again, where it does a nice gradual change in these projections over time. 6.13, 6%, 5.8, 5.7, 5.6, 5. So you don't have to go in there and change every single year individually. You could if you wanted to, but you don't have to do that. The other thing is taxes. Now, from what I see, most investors are not trying to map out what they think the taxes will be over the next 5 years. It's just not something we do a lot of analysis on because we don't have control over like Congress or the presidency. We don't know how laws are going to change in terms of business taxes. So it's not something that you typically bake into your analysis. But taxes do affect the cash flows of a company. So what we did here, what I decided to do, was simply take the last year's taxes, whatever year you start on. So 2022, it looks at the tax rate, the effective tax rate, and then it just moves that across the whole 5 years. Now, in reality, the effective tax rate for every company in the US should be 17%, or the tax rate should be 17%. But the government is not fair to every company. They treat some companies way more favorably than other ones. Some companies get subsidies, some companies get tax loopholes. We know how that works. It's just a crazy complex system. And that's why tax rates are different. The effective tax rate's different for different companies. For example, Amazon never pays a 17% tax rate. They find so many ways to reinvest and save on taxes. In Texas Roadhouse's case, theirs is 9.5% because they're a restaurant and they get, there's cattle subsidies and ways that they can save money on their taxes. So Texas Roadhouse typically never pays the full effective tax rate, and not many restaurants do. Otherwise, the whole restaurant industry they'd be in for trouble if they had to pay the full taxes. So you can, again, we give you the power to go in there and edit this if you choose to. So you can change every single year and bump the taxes up or down if you have your own opinions on this. But because people typically don't have big opinions on taxes, we're just taking last year and moving across the board. So that's our 5-year projected financials that spawned from these 4 inputs. And it just prints it out for you so you can use this to reference. You can screenshot it and save it. You can do whatever you want. It's really cool. I mean, this really saves you a lot of work that you'd normally have to do on spreadsheets that takes a lot more time. So here we have the scenarios tool building out the 5-year projection based on all the assumptions you made up here. So you've made the most informed assumptions you can. It builds out these 5-year projected financials. You do a quick review of this and make sure the numbers look good and make any adjustments that you think are appropriate. And then you have this nice little spreadsheet here, this nice little table with all this information. Now, there's a lot of numbers here, and you can kind of get lost in the numbers, but what we're really trying to do here is build for the cash flows. This is all about building out the cash flows. As an investor, we want to see how much money a company will produce. So all of it builds to this last line, the cash flow. That's all we're looking for. In specific, we're looking for this column right here. 2027, and we're looking specifically at 2027's cash flow. In this case, it's $396.49 million. Why is this number so important? Everything we've done up until now is literally just to get really this number. How much cash flow will the company produce in 5 years? Because if we can answer that question, if I could look into the future and I could know how much money a company is going to produce in free cash flow in 5 years, that information is invaluable. That would allow me to say, well, the company is going to produce this much cash in 5 years. What is the market cap today? What is the yield on that cash flow going to be? What are investors going to pay for it based on the predictability of the company? So if I have the cash flow, I know the company, I know the predictability of the company, I can assess an appropriate value. I can at least assess an approximate value of what the company will be worth. And I can then determine if it's a decent investment or not. This is exactly out of the Buffett playbook. Buffett looks for what he believes the cash flows will look like in 5 years or 10 years. He looks if the company has a nice discount from today to those cash flows based on the predictability and durability of the company. This is also exactly what investors like Dev Kantesaria do and other great investors. They build projections of what they think the cash flows will look like in 5 years. So that's all we're building to, is this number of cash flows in 5 years. And then we can use some different information to try to approximate what the return will be over this time. Now, we move on to my favorite part of this whole thing, which is the return calculator. When you hit this one right here and you build these assumptions, not only does it build out this 5-year projected financials, but it also builds out a return calculator based on all of this information. So let's go ahead and move on to the return calculator. You can see that I tried to design it with a visual element because I think that's the easiest way to digest information. But let me go through this. The return calculator has the logo again here. So if you share this with someone and you say, hey, I did this on Texas Roadhouse, it'll already know the company you're talking about. But let's go ahead and read the instructions. It says the return calculator gives you a distribution of returns based on 2 factors. So what is a distribution of returns? This means that it gives you, a lot of different possibilities. And that's because we don't know precisely what's going to happen. So you get a distribution of different possible returns, and it bases these possible returns on 2 different factors. The projection in cash flows, that's that number right there that I said is all important, 2027's cash flows. So it takes that number, and the yield those cash flows are valued at by the market. So Qualtrim takes this number, 396 million in 2027, and then Qualtrim uses this information of predictability, of the revenue growth and the margins. It pieces it together and it tries to determine what are those cash flows going to be trading at in terms of their yield in 5 years. Is it going to have a really high free cash flow yield, which means the company has a low valuation, or really low free cash flow yield because the company has a really high valuation? So I'll go ahead and go into more detail on how that judgment call is made. No prediction will be pinpoint accurate, so the return calculator will display a distribution of possibilities with the most likely scenario highlighted in blue. Okay, so right here, we have all the different return distribution. For each company you run analysis on, it'll give you a different distribution for each one of them. So for example, we have right here in this first column, and I'll do the chart first, and then I'll go into the graph here. But on this table, it says 1% free cash flow yield. For a company to trade at a 1% free cash flow yield, that means that it's an incredibly high valuation. And the only reason that companies trade at very, very high valuations or very low free cash flow yields, remember, the smaller the percentage here, the higher the valuation. That means the higher the expected return. People are paying a lot of money for this free cash flow, which means the yield is going down. So it's the inverse. This high percentage down here, 7.5%, that means that the company's yielding a lot of cash. People don't want to buy the company because it's either unpredictable or it's not growing fast. So it's a little bit inverse from what you think. A company like NVIDIA has a super low free cash flow yield. It trades at 1% because the company's growing so fast. So super fast and highly predictable growth means low free cash flow yield. Super slow growth or unpredictable free cash flow means very high yields. So if you have a pharmaceutical biotech company, that one's probably going to get a higher yield because it's unpredictable. Investors don't know what to pay for it, so they're going to not pay a high price for it. So this is the array of different possibilities that we have here. Now, based off the information I gave scenarios here, with a 13% growth rate, which is quite high, and medium predictability, the scenarios tool is saying, you know what, based on this information that we have, we think that it's going to trade between a 2% free cash flow yield and a 4%. That's our judgment call. Qualtrim doesn't know for certain, so there's no guarantees here. None of these predictions will be pinpoint accurate because we don't know what investors are going to ultimately value this company. Are they going to value it at a 2% or 4%? We don't know, but we can use the information given to make an approximation that's fairly accurate. If we look at Texas Roadhouse right now, let's go back to this page. Texas Roadhouse right now trades at a around a 2% free cash flow yield today. So Qualtrim's saying that right now it's probably trading a little bit expensive, but it's trading right in the range that we believe it will trade in 5 years. So Scenarios is basically making a judgment call that it's going to stay around the same level of free cash flow yield in 5 years that it is today. It might go down a little bit. There's times in history where Texas Roadhouse has gone down to a 4% free cash flow yield, but it's most likely going to trade in this range. Will Texas Roadhouse ever trade at a 1% free cash flow yield like NVIDIA? Probably not, because where's the explosive AI growth going to come out of? That's too high of a price to pay for a company that is a restaurant company, right? So it's probably not going to trade there. Is it going to trade at a 5 or 6%? No, not if it's growing 13% per year and it maintains these margins. For it to trade way down here, something would have to go wrong with the company. It would have to have margins go way down. It would have to be beaten by competition. So we don't think it's going to trade there either. So right now, we made a scenario where this tool believes it will trade most likely between 2 to 4% free cash flow yield in 2027, meaning the average is around 3%. Based on these assumptions, right now, Qualtrim Scenarios off of these assumptions believes the most accurate return is 10% per year. On the high end, if it maintains its 2% free cash flow yield, like it has today, if it stays at the same multiple, we'll have a 19% return. And on the low end, if we go down to a 4% free cash flow yield, so the valuation, the multiple goes down, the free cash flow yield goes up, people are paying less for the company in the future, then our return is 4% per year over the next 5 years. So there we have a range of return possibilities highlighted in blue. Now, if we move over, we can see a visual illustration of the same information. So this chart right here that's in orange and blue, it has the y-axis as the annual return and the x-axis as the free cash flow yield. And just like the chart here illustrates, it's the same information illustrated in visual format, so you can easily see the divergent outcome. You can easily see the magnitude of differences between the different valuations. And again, we see the very same thing. If the company is valued at a higher free cash flow yield, the annual returns will be lower because people are paying less. They're paying less for these cash flows. If the company is valued at a very low free cash flow yield, that means people really want to own this company. And they'll pay a lot of money for those cash flows. That's companies like NVIDIA that are valued at below a 1% free cash flow yield. Investors are willing to pay a fortune for NVIDIA's cash flows. The company in another way, trades at a very high valuation. And again, we highlight in scenarios, the tool believes that the blue range is the most likely of where this company will trade. Now, the way that it bases this is off of two big pieces of information. One of them is the revenue growth, and one of them is the predictability. So based off of 13% revenue growth, which is quite fast, and medium predictability, Qualtrim Scenarios is saying, you know what, this is a pretty good company. If it's going to grow 13% over the next 5 years, it's going to have medium predictability, then investors are probably going to value this company at around a 2 to 4% free cash flow yield, because that's a fast-growing, fairly predictable company. Fast-growing, fairly predictable companies get a valuation of around 2 to 4% free cash flow yield. If we were to change these, for example, let's just go ahead and do a few alterations. Let's change the revenue growth down to 7%. Much slower revenue growth. And let's change the predictability from medium to low. So now we have slower revenue growth and lower predictability. We hit update, and you can see the chart. It completely reconstructs the return projection. Now, no longer do we think it's going to be valued at 2 to 4%. We think it's going to be valued at around 5 to 6% free cash flow yield, because it's growing much slower and it has very low predictability. That's the worst of both worlds. You don't want a slow growing, unpredictable company. No investor wants that. So as no investor is willing to pay a lot of money for that, the free cash flow yield goes up, the valuation goes down, and the annual returns go down substantially. Down to right here on the chart, the annual returns at 5% free cash flow yield are minus 5% per year. So we're losing money every year. 5.5% is minus 7% per year. And then at a 6% free cash flow yield, if it ends up getting valued at that, we've lost 9% per year. So this is what happens if a company becomes less predictable over time. And we've seen examples of this. Remember when Netflix started losing subscribers? The predictability of the company in investors' minds went from high to low. And you could see the valuation collapse. Investors didn't want to pay for future cash flows because they thought the company was unpredictable. So this predictability rating is very important. It has a heavy influence on what Scenarios believes your return will be. If a company goes from being predictable to being unpredictable, the returns will suffer dramatically. And this will illustrate the suffering in returns. Like you're going to see negative returns from positive returns. If the company, on the other hand, goes from low to high, we can just take a look at this, right? We can change that. Again, Scenarios adjusted and said, hey, now the company is highly predictable. It's probably going to be valued between a 2 and 4%. So this takes a combination of revenue growth and predictability to build out where it thinks the company will be valued. But again, Qualtrim will not be pinpoint accurate, just like any other discounted cash flow. We're all making assumptions here, and we want to get in ballpark range of what those assumptions will be. We want to be as accurate as possible. That is why we give a return distribution instead of one singular finite a number that the company's worth. A lot of DCFs say the company's worth this amount, and you overpaid if you paid a penny more, or a penny, you underpaid if you paid a penny less. That's not how it works in investing. We're working with probability distributions, different possible outcomes, and we want to make the best judgment as possible with the most informed information. So the whole purpose of this Scenarios tool is to be very simple. The best projections are very simple yet eloquent. They're not extremely complex. They're not super, you don't have 50 different spreadsheets that you're going through. It's very simple assumptions of how predictable a company is, how fast it's growing to grow, what its margins look like. And then based off of that, we can make some assumptions of the range that we think a company will trade at in terms of its yield. And then we can reverse architect from there, which this does automatically, your returns you'll get on an annualized basis. So I hope you see the value in this. When I look at this, I can actually make pretty good assumptions. I can say I want it to grow at 12%. Let's say that I do think Texas Roadhouse is very predictable, for example. With this, I can see that I think it's going to be a median range of around 18% returns, which is right in line. It could go up to 1%. That'd be a 35% return, but I believe it's going to be more in the mid-range here. This gives you a range of possibilities. The middle one is the most likely. That's what it's assuming is going to happen. So under these conditions of highly predictable, I think it will be around 18% annualized returns. If I want to be more conservative, I can bump this down to medium, and this is probably a little bit safer of a prediction, where it will be around a 9% annualized return instead of 18. So there you have this tool. You can play around with it and use it. I've been using the same type of logic to make my investments. It follows very similar to investors like Dev Kantesaria, like Warren Buffett, where they make simple assumptions of where they think the company will be out in 5 years, what they think the durability or predictability of the company is, what the moat is and qualitative aspects. You can look at the numbers here, but it automatically prints all this information out. And then any great investor, Buffett, all of these guys, they will not know exactly what the returns will be for any company. You can ask Charlie Munger, and they would think it's nonsense to give you a perfectly accurate return projection. They look at probabilities, and they try to make their best bets with their best judgment. That is exactly what this is doing. So I'm planning on running a lot of scenarios, bear cases, bull cases, different things where I can see upside and downside for every company. You can add multiple scenarios for the same company. So I have the base case right here, but I can create a new one. And again, I can go down here, I name it, I can say bear case, and I can, say the revenue 7%. I can say that the company becomes low predictability, and I can hit create here. And it will create another one, and there you have it. The bear case, base case and bear case, I can switch between them. And you can name them whatever you want them to be as well. There's no limit to how many you can create. I haven't filled out some information here. To finish it, I'd have to plug in the market cap. So now it created my bear case really quickly. But there you go. It creates another bear case, and so you can swap back and forth between the two of them. And you can, again, do this for as many stocks as you want as well. So you'll create a list of it. It'll save all of the different scenarios and show you what they were historically as well. So you can return back to these in years and look at what happened. Now, again, you can use this as a tool to just test out different scenarios. What happens if the margins go up a little bit over time? What if they go down? What if it becomes a more capital efficient business? What if the revenue growth slows a little bit? What if the predictability is really highly predictable, but investors they're saying it's low predictability? That's essentially what I thought with Netflix a year ago. It was being priced as this. I thought it was this. And Netflix had a 100% gain in a single year. So when a company moves from low predictability to high predictability, you get immense gains when that happens. So you can make a lot of different scenarios here, and that can help inform your thoughts about the company. And the thing I like about this tool is how easy it is to use. Complete ease of use. No dealing with spreadsheets, no complex formulas. You literally go in and change a few variables, and you can see the different outcomes. You can see the probability return distributions. You can play around with a lot of the estimates. So that is it. I hope you enjoy it. I think that this rounds out Qualtrim a lot. We have insights for all the historical stuff. We have scenarios for all the future stuff. I think this will help give a lot more full picture of a company. So let me know what you do with it. And if you're using the tool, make sure to join us on the scenarios chat on the Discord. We're going to have continued discussion with it there. That's all for now. Let me know what you think.